Now we'll talk about the 5 degrees, right? 5 degrees of price elasticity of demand. These are very important and you should be knowing this. So firstly is unitary elastic demand. If the percentage change in quantity demanded is equal to the percentage change in price of commodity. Let's suppose, I don't have the equation for this. Percentage change in the price, let it be like there has been reduction by 10 and there has been increase in demand by 10. In that case there will be unitary elastic demand. Unitary basically means one elastic, elasticity of demand will be is equal to 1. So if percentage change in the quantity demanded is equal to the percentage change in the price of commodity, then elasticity of demand will be equal to 1. This is known as unitary elastic demand. You have to know this, right? Because you will be getting a question based on elasticity of demand, definitely, right? Second, more than unitary elastic demand or elastic demand, right? So we are talking about greater than 1. We are talking about elasticity of demand greater than 1 if percentage change in quantity demanded is more than percentage change in price of the commodity. Now we're talking about, let's suppose the quantity demanded increases by from 100 to 120 and the price has decreased by 10. So here the percentage change in quantity demanded has increased by 20 and the change in prices is rupees 10. Then we will get a elastic demand. So percentage change in quantity demanded is more than percentage change in price of the commodity. Then elasticity of demand is greater than 1 and result is known as more than unit elastic demand. So we can say this as elastic demand as well. Now the third thing is less than unitary elastic demand, because when there is more, when there should be less as well. So if percentage change, it will be simply opposite of it. If you remember this, if you are able to understand this, you can basically derive this one as well. So if percentage change in quantity demanded is less than the percentage change in the price of commodity, then elasticity of demand will be less than 1. So there is this example we're talking about. The change in price is by 10 rupees, but the increase in demand is rupees 5 only. In the last example, it was the change in price was rupees 10 and the increase in demand was by 20, right? The price was fallen by 10, the demand was increased by 20. So that was more than unitary or elastic demand. But in this, we are, uh, you know, tackling the situation of inelastic. We're learning about the inelastic demand. So the price has fallen by 10 and the demand has increased by only 5. So the formula is change in Q upon change in P into P by Q. So change in Q is 500, it increased by just 5, and change in price is 10, it increased by 10, into P by Q. P is original price is 50 and original demand is 100. So 0.25, and this minus sign indicates because the change in price is negative, right? So my negative signs indicate the inverse relationship between price and the quantity demanded, right? Because the change in price is negative, the price is following and there is increase in demand, so there is negative sign. So negative sign basically indicates the inverse relationship between price and quantity demanded, right? Now we're talking about perfectly elastic demand and perfectly inelastic demand. These are the things that are we left with. So if quantity demanded changes and price remains constant, then elasticity of demand is infinite, and the result is known as perfectly elastic demand. This will be the figure. And sometimes these days examiner are pretty smart. They won't ask you the statement, they won't give you the formula, they will give you this graph and you have to identify which one is it, right? So perfectly elastic demand is basically this. Perfectly elastic demand is this, infinite. And how does that happen? I will tell you. Because in this, quantity demand changes and price remains constant. So the price is 4 and the quantity demand has increased. Now the change in quantity is 10 but change in price is 0. So if we divide anything by 0, that will give us infinite value. I think everyone must be knowing this. So if quantity demanded changes and price remains constant, then we are talking about perfectly elastic demand, and we have to remember the graph as well, because the diagram will come. they will ask you to match the following as well. So you should be remembering that infinite demands because price remains same and quantity demanded has increased. Okay, now we are talking about perfectly inelastic demand. Now in this case it will be opposite of it. The price is changing but quantity demand remains constant. Now the price is changing and the quantity demand is constant. So elasticity of demand is zero and the result is known as perfectly inelastic demand. Right? So we're talking about perfectly elastic demand and now we're talking about perfectly inelastic demand where price changes but quantity remains same. So we're talking about change in price but quantity remains same. Here elasticity of demand will be zero, will zero change in quantity, change in price is 2 into original price 2 divided into divided by 10 because that's the original demand as well. So 0 by 20 gives us 0. And this diagram, because you have to remember this in the last thing, the price, because price was constant, and then we draw a horizontal curve in this, quantity remains constant, so we draw a vertical line. So this is perfectly inelastic demand. This is perfectly elastic demand. I hope everyone who is watching is pretty much clear with what's the difference. And if you remember this thing, you can obviously derive this one because in perfectly elastic demand, quantity demanded changes, price remains same. In perfectly inelastic demand, price changes, quantity demand remains same. So this is all about uh, 5 degrees of price elasticity of demand, and you can definitely expect a question based upon this. You should be knowing this, you should be knowing how to draw demand curve and all these how to represent all these elasticity of demand as well. I have shown you perfectly elastic, perfectly inelastic, and greater than one, and there will be a less than one as well, right? Sorry, this is less than one. There will be a greater than one as well. So you should be knowing every one of this, and we have covered majority of elasticity of demand and what it is about. I hope everyone who has been following today is been able to understand the elasticity of demand because it is an important topic as I have been saying, and you can definitely expect a question based upon this. And it's like because there are so many units in economics, and sometimes people are like, I should be ignoring demand, I should be ignoring utility consumer equilibrium, and because I am very well aware about the fact because I have studied in 12th class, I'm very good at economics. But at times what happens when you are sitting in an examination, when you haven't given any mock test, such question appears and you get blank. You are like, how to respond this and how to answer this question, and that's where you miss out on easy question because as I've been saying, you won't be getting 200 difficult question in examination, you will be getting a mixed bag. And sometimes easier question comes from this because it is easier for majority of the students. And what usually happens when you are prepared for the difficult ones, you miss out on this one, right? And you attempt, because there is no negative marking, you will attempt anything, you will attempt everything, and somehow, because these are the scoring areas, I definitely don't want any of the students who are following the video to miss out on these simple questions. And lastly, I think I want to touch upon this one, the cost and economics. And these are very important as well because explicit and implicit cost has been asked in the examination multiple times. So cost of producing a good in economics is the sum total of all the direct expenditure, direct expenditure, indirect expenditure, and certain minimum profit. So direct expenditure is basically actual money that has been spent by a firm on purchasing goods or hiring factor service. So these are called explicit costs, which you can basically see. You can see that I am purchasing a firm, like I am purchased a building, I have purchased a warehouse, and I am purchasing goods, and I'm hiring services from people, I'm hiring laborers, and those are the services you know that you can basically see. So that is called direct expenditure, and that will be categorized under explicit cost. Now indirect expenditure are imputed value of the owner's estimated value of inputs provided, called implicit cost. So implicit cost, what is it? We'll talk about this with the help of an example so that you are very much clear with the difference between explicit cost and implicit cost. Certain minimum profit refers to the amount of profit which a producer must get in. the long run to continue to produce the given goods called normal profit. So you need to have normal profit in the longer run, else your company will not sustain after a while if they are suffering huge losses. Right. So firstly, we'll talk about explicit cost. It refers to the actual money expenditure of a firm on purchasing goods or hiring factor services and non-factor inputs like raw material, electricity, fuel, etc. Right, so I have to spend money on electricity bill, on fuel bill, on raw material because I have to produce good. I need raw materials. I need to buy machine. So all of those costs will come under the category of explicit cost. For example, in other words, explicit costs are those cash payment which the firm makes to outsider for their goods and services. For in this explicit cost, I am making payment, I am paying someone, I am paying outside of the firm, right? So these are the cash payments which the firm makes to the outsider for their goods and services. For example, explicit cost of biscuit factory consists of flour, milk, sugar, etc. purchased from outside, and rent, electricity, wages, interest paid to the factors of production, right? So this will be coming under the category of explicit cost, right? So I hope everyone who is watching the video is pretty much clear with what explicit cost is. So actual money expenditure that I'm paying to the outside of my firm. Now what is implicit cost? Implicit cost is the imputed or estimated value. Firstly, we need to focus upon this. Implicit cost is the imputed or estimated value of inputs supplied by the owner firm himself. Let's suppose if I have bought a warehouse, now I'm saving some money on the rent. That will come under the category of implicit cost, right? So now if I'm heading my firm, if now I'm heading my firm, I am not appointing someone else to take care of all those services. I am now managing all those services. I'm not managing all the work myself. But in case if I wasn't doing that, right, I'm not paying myself the salary. If someone else was doing all those work, I would have paid that person the salary. So that will be coming under the category of implicit cost. Implicit cost is the imputed or estimated value of inputs supplied by the owner of the firm himself. In other words, implicit cost are cost of self-supplied factors of production, which are generally not recorded in firm's account books. So you won't be recording that, okay, imaginary rent, right? You won't be recording imaginary rent that it would have been the rent of this place. Now, implicit cost of a biscuit factory are imputed rent of owner's own factory building. Because now, if I own the factory, there would have been rent. If I didn't own the factory building, I would have paid some rent. So that is implicit cost. Imputed wages for owners working as a manager himself. So if I am working as a manager, right? If I wasn't working as a manager, I would have paid someone else to work as a manager. So I'm saving upon that money. That is that would have been my cost. So that will be coming under the category of implicit cost. Imputed interest on his money capital used in the factory. So now if if I wouldn't have invested that money in the factory, I would have invested in some financial instrument. I would have earned an interest. I would have kept all my money in bank account. I would have earned some interest saving accounts in fixed deposit. So I'm losing out on that interest. So imputed interest on his money capital used in the factory. So I have used that all of my money in the factory. If because there is opportunity cost associated with everything, so I would have kept that all the money in my bank account, saving account. I would have earned interest. So that all will come under the category of implicit cost. So these are the differences between explicit and implicit cost. uh, you won't basically get a question upon explicit and implicit. There will be four categories, and then you have to match the following. There will be four types of cost mentioned on the left hand side, and there will be the definition mentioned on the right hand side, and you have to select the right one. So you have to know the concept of explicit and implicit cost as well to find out the right definition. So I hope I have made myself pretty much clear with what is explicit cost, what is implicit cost, and that will be all for today's class. But a final reminder that if you are liking the content that we are providing, if you are liking the way that we are teaching, so what you can do is basically like the video, subscribe to the channel, and leave and mention in the comment section that okay, that we were able to understand this, we were able to understand this concept, or sir, you could touch upon this one, or could highlight the important question. So I will take up those questions in the next video, and that will be the only way through which we can interact. And I want more of your contribution from your end as well, because if we will engage in this conversation in um, while preparation, so I will be very providing you those inputs which will help you to clear the examination in your first attempt, right? So that will be all for today's class. I think I have been pretty much clear with the elasticity of demand, the shift in demand curve, and the finally the cost in economics, right? There are a few other things that we will cover in the next class, so stay tuned to TalentBlazer and do subscribe to the channel. And if you haven't downloaded their app from the Play Store, please do that, because it is very important. TalentBlazer app has so many mock tests that are available for free, so you can attempt those mock tests, and those will definitely help you to clear the examination. So download the TalentBlazer app from the Play Store. The link for the same will be mentioned in the description below. And subscribe to the channel if you haven't till now. And do leave a like. And if you have anything to talk about, do mention in the comment section as well. Thank you for joining. We'll meet you the next time.